Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing TKO stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 10 billion market cap. They're trading at $118 a share and they have 81 million shares outstanding. TKO operates as a sports and entertainment company. It produces and licenses live events, TV programs, long-form and short-form content, reality series, and other filmed entertainment on digital and linear channels, as well as pay-per-view. The company's involved in merchandising of video games, apparel, equipment, trading cards, memorabilia, digital goods, toys, and you probably didn't know this, but the sale of travel packages and tickets. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Really consistent free cash flow between $400 and $500 million. Look at their margins in 22 and 23, over 40%. Still 19% ain't too shabby. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was negative in 2024 and the trailing 12 months. Revenue is the sales for the company, and that went up 150% from 1 billion to 2.5 billion. Really nice growth from 23 to 24 and from 24 to the trailing 12 months. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 16 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $12.6 billion. We divide that by 81 million shares. And we get a calculated stock price of $155. They're trading at $118, so they're trading at a 24% discount. It's a buy according to the model. Do you think it's a buy or a sell? Let me know in the comments. Look how close I am to Simply Wall Street. They're at 154. I'm usually not this close to them. They say the stock is 23% undervalued. 16 analysts priced this stock at 132. They also say it's undervalued. There are 42 companies in the same industry as TKO, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend $80 million in CapEx. These are the investments in property, plant, and equipment. Their debt to equity ratio is pretty close to the median. For every dollar of equity, they have 80 cents of debt. They don't pay a dividend, $500 million of free cash flow. They rank 10th in market cap, 9.6 billion. Price to book is a little worse than the median, 2.5. Price to book is market cap over equity. We can't look at that PE, negative earnings. Price to free cash flow looks pretty good at 19. Price to sales 3.8. This means investors are paying $4 for $1 of revenue. They generate $2.5 billion of revenue, a lot lower than the average. We can't look at their 5-year annual revenue growth rate. They have not been public that long. Here's their latest income statement, second quarter of 23, second quarter of 24. Revenue up a ton from 300 million to 850 million. It nearly tripled. Their expenses also went up a ton. Total operating expenses 600 million. Cost of revenue, 259 million. SG&A, 230 million. 100 million depreciation. Operating income went from 140 million to 250 million. So margins went down. Last year, their operating margin was a little under 50%. Now it's in the high 30% range. They spent 66 million of interest on their debt. Pre-tax income, 190 million. 40 million of taxes. Net income, 150 million. Last year, net income of 83 million. And they have 81 million shares outstanding, 82 million on the diluted basis. So to summarize, I have them trading at a 24% discount, ranking 6 out of 10. Would I buy them? They do seem a bit appealing, so 6 out of 10. They seem to be profitable each year, at least they're generating positive free cash flow. Ratio is 5 out of 10. We can't look at that PE. Price to free cash flow is fine. Financial 7 out of 10. Their revenue is growing a lot. Free cash flow, a modest growth, but they have good margins. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.